Hello everyone, welcome to CFI Education, and in this video we are going to talk about debt amortization schedule and how can we prepare this schedule in MS Excel. So let's get started. So I have created a simple case here where the debt amount that we have for this case is 1 CR. The interest rate applies on that debt is 10% annually, and the amortization that the time period available is 20 years. It means that we have to pay back this money to the bank in the next 20 years, right? And in this schedule, you'll get to know what are your interest and principal repayments that you are doing every year to amortize it off in the next 20 years, right? So I've just added 20 years here in a column. Then I've added opening balance, interest payment, principal payment, closing balance, right? So in the opening balance, we will have 1 CR link from D4, and then we will calculate the interest payment using a function called IPMT, right? So IPMT is the formula which we can use directly to calculate the interest payment, right? So the component that you need to calculate it, the first is the rate. Rate is your rate of interest. So you just select D5, then comma. The next is PER. PER means which period of rate of interest you want to calculate. So this is the first time you will be paying the interest on this loan, and this is your first period when you'll be paying this interest. So you can select this as 1, which is B11 cell. Then NPER means number of periods. So this is the first, but what are the total number of periods that you have in this loan? So in this case, you will select 20 years, comma, then you need present value. So what is the present value? The present value is the loan amount that you have received it today from bank, and you have to keep it under PV. So the cell is D4, then comma, then FV means future value. So we do not have any future value in this case. So we'll keep it blank, and then we'll put another comma. And the last thing that we have to put is end of period and beginning of period. So it is end of period. So we will put 0 in this case and close the bracket. So this is the IPMT formula that you have put in. Now for the principal, we will put another formula which is called PPMT. PPMT. Same number of matrices or things and the input data actually you need here. Rate of interest again is 10%. Per is 1. Number of periods are 20. Present value is 1 CR, comma, comma, and then 0. Just close it and you'll get principal repayment. And then next is you will have you have an opening balance at the start of the year as 1 CR, and in this year and you have paid this much of principal amount of your loan. So your remaining closing balance will be this. So you have paid this much and you're left with 98,25404, which will become your next year opening balance. So you can just link it this way. And now you need to do some sort of freezing some formulas, the cells, so that the formula works. If we drag it, let's say if we drag it here, it will not work because your cells have changed. So for that, you need to freeze some of the cells. So D5 is what? Your rate of interest. It will get completely freeze. Just hit F4 and you'll be able to freeze it. B11 is your number of years. So here you just need to freeze column B. You do not need to freeze the numbers. So just hit it thrice and you will be able to freeze it. Third is D6. It will be completely freezed. D4 is your debt. you'll also freeze it here. And now if you just drag it, it will work exactly, it will work completely fine. Only the per has changed and the numbers are still the same. And that way you can drag it down till 20th year. You can also drag this down the opening balance for a time being. Now let's come back to the principal repayment. Here you also have to do the same thing, freezing of the cells, so that suppose you do just drag it here, it should work. Right now, if you will not drag, it will not work. So D5 will be freezed. Here you just need to freeze the B column. This will be completely freezed. This will be completely freezed, and I think it should work now. So now, since you have just dragged it, you are able to see all the repayments that you have done in this loan. Now the last thing is you'll freeze it. You'll just drag the closing balance, and your debt amortization schedule is ready. So we can just spend a minute of time how it is working. So your opening balance was 1 CR for the loan that you have taken for your business. The interest payment at 10% you paid this much, which is 10 lakh. Then principal you paid this much. Then you had a closing balance. This minus this will be your closing balance. And it has become an opening balance for the next year. So every year, the last year closing balance is becoming the next year opening balance. And every year you are deducting the principal payment to arrive at the closing balance. Right? So and 20th year, you can see at the end of 20th year, you do not have any debt balance which has to be paid, because you had 20 years of amortization. You are able to pay your loan or debt, whatever you call it, in 20 years. One interesting thing to see here is that as and when you start paying your principal, right, it keeps on increasing year on year. So first year was around 1,74,000, then 1,92,000, and so on till last year you paid this much of amount, which is 10,67,000 something. And in interest, as and when you start paying your principal, your interest will go down in the future. So it is always the case that whenever you start paying your principal, the interest keeps on going down, and the vice versa will happen to the repayment of your principal amount. It will keep on increasing. And if you'd like to check how much interest and principal payment you have, paid every year, so you can use another formula which is called PMT. PMT is the formula used to calculate the EMI, the equated monthly installment that you are paying. In fact, I would say as in years. It will not be a monthly installment. It will be a yearly one. So let's also see the PMT formula, how it works. Rate is 10%. NPER is 20 years. PV is your debt amount. You do not have any future value. It will be blank and then 0 at the end of the period. And you can see that this much is your EMI, and it is going to be the same because there is no, sorry. So I need to freeze it, all the three, and then drag it. So it will be same every year you have to pay for the next 20 years. And if you want to do a check, you can do that as well. Just do this. If you do interest plus principal, so anyways, you'll be just paying interest and principal every year. So that will create an EMI for you and it will match. So you can see that it is matching and giving a true case. If you drag it, it will always match. So every year you are paying exactly like an EMI. So whether you so in other words, if you want to just calculate the total interest and principal you are paying, you can use the formula PMT. But if you want to know within that EMI how much interest you are paying separately and how much principal you are paying, you need to create a debt amortization schedule. And moreover, this debt amortization schedule can also be used in case of any kind of individual loan that you take, whether it is a home loan, personal loan, any kind of loan. Just you need these information from the bank, how much loan that you have taken, what is the rate of interest, that what is the number of years, maybe. So especially in case of home loan and personal loan, you need to calculate monthly numbers because generally you pay EMI in a monthly format. So instead of using these two numbers, annual numbers, you will be using a monthly number, which should be this into this. So instead of using this, you'll use this in case of your individual case of home loan or personal loan.